Welcome back to the Mortgage Reports. Today we're diving into a topic that shapes nearly everything about the reverse mortgage world: interest rates. Most homeowners know interest rates affect traditional mortgages, but they may not realize how much those same rate movements also impact reverse mortgages, especially HECMs. Now, whether you're thinking about getting a reverse mortgage or already have one, understanding how interest rates influence your borrowing power, your available funds, and the long-term growth of the loan can help you make smarter decisions. In this video, we're breaking down how interest rates affect HECMs, why the market shifts the way it does, what rising or falling rates actually mean for your loan, and when timing really matters. Let's get started. Question 1. How do interest rates affect reverse mortgages? Well, just like with traditional home loans, interest rates play a huge role in how reverse mortgages work, but in a slightly different way. When rates go up, the amount of money available to borrowers usually goes down. When rates go down, borrowers can often qualify for more funds. That's because interest rates influence the projected growth of your loan balance over time. Higher rates mean the loan balance is expected to grow faster, so lenders often approve a smaller initial amount. Lower rates mean slower growth, allowing borrowers to access more of their home equity up front or through a line of credit. So while interest rates don't change your monthly payment, because reverse mortgages don't require one, they do change how much you can actually receive. Question 2. What types of interest rates apply to HECMs? Now, most HECM reverse mortgages come with variable interest rates, which means the rate can adjust over time based on broader market conditions. These loans are typically tied to a financial index that moves up and down with the economy. There are also fixed rate HECMs, but they usually only apply to lump sum payouts and come with stricter limits on how much you can borrow initially. Variable rate HECMs, on the other hand, allow for lines of credit and monthly payments, which is why many borrowers prefer them. The type of rate you choose affects not just your flexibility, but also how your loan balance grows over the years. Question 3. What causes interest rates in the HECM market to move? Well, interest rates shift based on several broad economic forces. Inflation, Federal Reserve policy, investor demand for mortgage-backed securities, and overall economic stability all play major roles. When the economy is strong and inflation is higher, interest rates tend to climb. When growth slows or the Fed wants to stimulate the economy, rates often fall. The reverse mortgage market follows these same patterns because lenders based HECM rates on the larger financial markets. So even though HECMs are unique loans, the forces that move their interest rates are the same ones that affect traditional mortgages and other consumer lending. Question 4. How do rising interest rates affect homeowners considering a reverse mortgage? When rates rise, homeowners generally qualify for less money than they would when rates are low. This can impact how much is available for a line of credit, lump sum payouts, or monthly income. Rising rates can also affect existing borrowers who are thinking about refinancing their reverse mortgage. Fewer available funds may mean a refinance is less beneficial. However, rising rates can also make the line of credit growth factor more attractive. With many variable rate HECMs, the unused portion of the line of credit grows at the same rate as your loan, which can mean faster growth when rates are higher. So while rising rates reduce initial borrowing power, they sometimes increase the long-term value of the available credit. Question 5. How do falling interest rates affect the HECM market? Now, lower interest rates usually work in favor of homeowners. When rates drop, borrowers often qualify for more funds, which can open the door to larger lump sums, higher monthly payments, or bigger lines of credit. Falling rates may also make a HECM refinance more attractive because homeowners could gain access to additional equity or reduce the long-term cost of the loan. Lower rates also tend to boost the overall housing market, which can push home values higher, creating even more available equity for reverse mortgage borrowers. Now, in short, falling interest rates tend to expand options rather than limit them. Question 6. When is the best time to get a reverse mortgage based on interest rate trends? The best time to move forward with a reverse mortgage is usually when interest rates are stable or trending downward. This is when homeowners typically qualify for the highest loan amounts. However, timing isn't everything. Your long-term goals, your home's value, and your need for funds matter just as much and sometimes more. Some borrowers choose to secure a reverse mortgage earlier to lock in growing line of credit before rates climb. Others wait for lower rates to maximize their available equity. The key is understanding how rates impact your options so you can make a well-timed decision that aligns with your financial plans. Now, here are some real-life examples. Example 1. Linda considered getting a reverse mortgage during a period of rising interest rates. Because she waited several months, her available line of credit dropped noticeably as rates climbed. Once she realized the impact, she decided to move forward quickly to secure the best amount she still qualified for. And she benefited from a growing line of credit that kept pace with the higher rate environment. Example 2. Mark watched interest rates decline over the course of a year. When rates finally hit a low point, he applied for his HECM and qualified for significantly more than he would have just a year earlier. The lower rate also made a long-term line of credit more affordable, giving him flexibility for future healthcare needs and home improvements. So interest rates shape almost every part of the reverse mortgage experience, from how much money you can get to how your loan balance grows over time. So just to summarize, higher rates usually reduce your available funds while lower rates expand them. Market forces like inflation and the Federal Reserve policy drive most rate movements. And variable rate HECMs offer flexibility while fixed rates limit how much you can take upfront. Now, timing your loan around rate trends can increase your borrowing power or strengthen your long-term financial plan. Now, if this video helped you better understand how interest rates influence the reverse mortgage market, give it a thumbs up, subscribe to the Mortgage Reports, and hit that notification bell so you never miss future videos that simplify big housing topics. And for more insights and examples, check out the full article linked in the description. Thanks for watching, and I'll see you in the next one.